All right, debits and credits this week. If there is a week that everybody dislikes in this class, it's this week. I've taught this class for a number of years, and whenever I tell individuals what I do for a living, if they've taken an accounting class, they usually reference this chapter. They're like, "Oh God, I hated that class. I hated debits and credits." So, um, it wouldn't surprise me if 25 years from now you still remember me, still remember this class, and still remember this week. But in fairness, it's not really that bad. Um, there's really three things that we want to cover this week. Um, and it's really all just sort of one thing. Um, And once we understand the main concept, everything else sort of just like falls into place. But if you remember where we were last week, we were observing transactions and then we were getting those transactions into the accounting equation. Then once everything was in the accounting equation, um, we were taking that and throwing it into the financial statements. Okay. That was the process last week. And that's actually still the same process this week. We're still looking at observing transactions and getting them into the accounting equation. To me, for the first 3, 4 weeks of this course, that's really the hardest part. It's not the math. It's really understanding what accounts get affected, and then trying to figure out whether those accounts are assets, liabilities, and equities. And then now we're going to add one layer of complexity. And essentially, what we're going to do is we're going to introduce this concept of a T account. And then after we talk about the concept of a T account, we will then talk about a journal. And I'll do that in the next video. And then we'll talk about a trial balance. And I'll do that in the third video. But essentially, the T account, the journal, and the trial balance, that's the main takeaway of this week. And this lecture is really kind of diving into the T accounts, okay? So when we think about T accounts, um, well, let me back up. If I think about all of the accounts in the accounting equation, right? So I have assets, and then I have assets equal liabilities plus equity. All right. When I think about all of the specific accounts, I have accounts, I have assets accounts, and like the most common one that we were talking about last week is cash. And so now if I think about the cash account, moving forward, I'm now going to think of it as being a T. It's a T account, right? Same goes for accounts payable. Accounts payable is a liability, okay? And accounts payable is also going to have a T account. And then I can have, I don't know, capital is another one. Capital could be a T account. And then maybe I can have revenue, and revenue is a T account. But every single account that we have in our accounting system is now theoretically a T account. And when we keep track of things, we're going to keep track of things either on the left side of the T account or the right side of the T account. And same goes for all the liabilities and equities. Let's just talk about cash first, okay? Now, cash. What side of the accounting equation is cash? Is it on the left side or the right side? It's clearly an asset, so it's on the left side of the accounting equation. And therefore, we typically refer to cash as being a left side account. Meaning, if I want to add something to cash, I would add it to the left side of the T account. Say I want to contribute $10,000 of cash to the business, I would show the 10,000 in cash to the left side of the T account. That would represent an increase to cash because again, cash is on the left side of the accounting equation. And then rather than using minus signs or subtractions or um, parentheses, if I wanted to show the use of cash, I would show the use of cash on the right side of the equation, right? So if I spent or if I used $2,000 to purchase supplies, I would show the use of cash on the right side of the accounting equation. Then maybe I sell some services to a customer. They pay me $5,000 in cash. I would again show the 5,000 on the left, and then I would show again, I could use some more cash. Maybe I could buy some land. I'll buy cheap land. I'll buy actually, let's say I spend 7,000. Okay. Now, if I wanted to know how much cash I had, I would simply add up all of the left side amounts, 15,000, and then I would add up all of the right side amounts, 9,000, and then I would add and subtract. So if I have 15,000 left side amounts that increase cash and 9,000 right side that decrease, I think I'm left with 6,000 is my available cash. Okay. Now let's talk about accounts payable. Accounts payable is on the right side of the accounting equation, right? Accounts payable is a liability. And therefore, if I want to show an increase to liabilities or an increase to accounts payable, I would do it on the right side of that account, right? So if I purchase supplies on account and I I don't know, I purchased $6,000 of supplies on account, I would show the increase to accounts payable of 6,000 on the right side, right? I could purchase more supplies on account. And then if I chose to like make a payment to lower accounts payable, say I wrote a check for $4,500 to pay down some of the amounts that I owe this particular vendor, I would show the reduction to accounts payable on the left side of the T account. Again, since liabilities are on the right side of the accounting equation, we typically refer to them as right side accounts, meaning if I want to increase something on the right side of the accounting equation, then I would increase that account with the right side of the T account. And in this particular example, I would do the same thing. I would add up all the right side amounts. I have, sorry, 8,000. And then I would add up the left side. And then at the end of the day, I think I would have still an outstanding debt of 3,500. Capital would work the same. Revenue would work the same. All right, we could talk about revenue just very quickly. Actually, we could talk about capital and revenue. Capital is an equity account, and therefore, if I want to contribute cash to the business, I would show the contribution of cash to the business on the right side of the capital account because capital is on the right side of the accounting equation. Therefore, if I contribute $100,000 of cash to the business, I would show the contribution of 100,000 on the right side of the account. If I wanted to show the recognition of revenue, I would show the recognition of revenue on the right side of the account. Okay. I want to talk about two things that may be confusing. So now we have assets equal liabilities plus equity. And now I want to talk about, we remember we have capital and then we have retained earnings, okay? And under retained earnings, we kind of have a beginning balance. We have revenue. Then we have expenses and dividends. Okay, you're definitely going to want to pay attention to this portion of the lecture or even take notes better. Okay, revenue. Revenue is an equity and it has the effect of increasing equity. And therefore, like I was saying earlier, typically it's the case that revenue has a right side balance because revenue increases equity and equity is on the right side of the accounting equation. Okay? Same with capital. Now, let's talk about expenses for a second. Expenses are on the right side of the accounting equation. However, they have the effect of lowering equity, right? So as I incur expenses, my equity goes down. And therefore, if I want to show an expense, I'm typically going to show the expense on the left side of the expense account. So say I pay my employees $2,000 in cash, right, for salaries. I would show the payment of $200 on the right side of the cash account because cash is on the left side, and therefore if I want to drop something on the left side, I do it with the right side of the account. Now I would show the increase in expense on the left side of the expense account because the left side of the expense account will lower my equity. Okay? And dividends are the same thing. If I wanted to pay a dividend of $5,000, I would show the $5,000 deduction, the cash on the right side of that account. And then I would show the $5,000 dividend payment on the left side of the dividend account. And again, like expenses, dividends lower my equity. And since equity is on the right side of the equation, and I want to drop something on the right side of the accounting equation, I would do it with the left side of the T account. Typically, it's the case that expenses and dividends give most of us the most problems. Okay? Now, another concept to keep in mind. Unfortunately, in accounting, we don't use left and right. Okay? Just to make things more confusing, whoever invented accounting, they didn't speak English. I think they spoke Italian. Don't quote me on that. But so they didn't use left and right. Instead, what they used was debit and credit. So here's the deal. The only thing debit means, and again, I would definitely take notes, the only thing debit means is left. It doesn't mean increase. It doesn't mean decrease. It doesn't mean you're using your debit card in your bank account. It only means left. It is literally just that. And on the other hand, credit, it only means right. It doesn't mean increase and it doesn't mean decrease. Okay? So instead of saying the left side of the T account, the right side of the T account, all we're going to say is the debit side of the T account and the credit side of the T account, right? So cash, again, it's just going to have a debit side account, DR is short for debit, and a credit side. And then accounts payable, right? It's also going to have, a debit side and a credit side. What helps me remember all of this is, I'm a simple person and I get confused easily. So I always think about things in terms of either food or sports. And in this particular example, I think of it in sports. So I have a field goal post, right? And on the left side of the field goal post, I put assets. And therefore, if I want to increase assets, I'm doing it with the left side, the debit side. And then liabilities and equities, if I want to increase liabilities and equities, since they're on the right side of the field goal post, I would increase those with the right side of the T accounts. And then the opposite is true. On the asset side, right, I would decrease assets with the credit side of the T account. And with liabilities and equities, I'm going to decrease those with the debit side of the T account. So that just the opposite's true. I will tell you, there are tons of videos on YouTube that talk about debits and credits, the T accounts, left side, right side. There's all sorts of systems. Everybody who teaches this course or has taken this course has devised a system to help them remember the debits and credits rules. And I would highly encourage you, you could use mine, you can use the discussion that I just went through, and you can also just go on YouTube and use somebody else's system or create your own system. But in essence, like this shouldn't be what the big takeaway of the class is, and it also shouldn't be what holds you up for the rest of the semester. This is just a method that we use to take transactions in a more sophisticated way and put them in the financial statements, right? But again, the big takeaways are the financial statements, understanding how transactions impact those financial statements.